Today is April 14th, 2026, and yesterday, CoreWeave closed at $110.27.
Right, which is a massive single-day jump. I mean, over 8%.
Yeah, exactly, over 8%. But, if you look under the hood of this AI juggernaut, you see some really extreme, violent price volatility.
Oh, absolutely. The swings are wild.
And you see absolutely massive insider selling from the very people running the company. So the question for you, the listener, is this. Are you looking at a strong buy on a historic AI dip? Or are you staring at a devastating value trap just waiting to crush retail investors?
That is the defining question in the market right now, honestly. We're looking at a situation where the underlying business fundamentals and, the day-to-day price action are telling two completely different, almost contradictory stories.
Yeah, and our mission today for this deep dive is to cut through that noise. We're going to examine the raw financial data, the technical charts, the analyst models, and those really questionable insider moves.
Right. We want to understand the actual mechanics of what is happening with CoreWeave stock.
Exactly. And just a quick housekeeping note right up front, we're strictly analyzing the source data today. This is an exploration of financial mechanics, not financial advice.
Yeah, no financial advice here. It's really about understanding the why behind the numbers.
Right. And speaking of housekeeping, whether you're listening on the go or watching us, make sure to like the video, subscribe to our YouTube channel, and it is absolutely compulsory that you leave a comment with your feedback.
Yes, please do.
It really helps us tailor these deep dives specifically to what you want to learn. So, okay, let's start with that engine, because the contradiction here is just fascinating to me.
It really is.
On the surface, the income statement looks like a flawless victory. I mean, we're talking about unprecedented, record-breaking revenue growth.
Yeah, unprecedented is almost putting it mildly. In fiscal year 2025, CoreWeave hit a historic milestone. They officially became the fastest cloud provider in history to reach $5 billion in annual revenue.
Wow, $5 billion.
Yeah, their exact top line was $5.13 billion. That represents a 168% year-over-year growth rate.
That's insane.
I mean, for any company at any scale, achieving triple-digit growth while operating in the billions is just a monumental feat.
Okay, wait, help me understand that. How can a company be celebrated as the fastest ever to $5 billion, generate that kind of explosive cash, and still, manage to bleed over $1 billion in a single year? Where is all that money actually going?
Well, that is the multi-billion-dollar question, right? And to answer it, we really have to look past the top-line revenue and look at the GAAP net loss.
GAAP being the standard accounting rules.
Right. Generally accepted accounting principles. It's the strict, standardized way of calculating a company's actual bottom line after every single expense is accounted for. And you are correct. Their GAAP net loss was a staggering negative $1.17 billion.
So they're bringing in $5 billion, but spending over $6 billion.
Precisely. And it's heavily driven by the brutal reality of AI infrastructure expansion. I mean, to be the premier AI cloud provider, to service clients like Meta and Anthropic, you can't just rent server space.
Right. You need the hardware.
Exactly. You have to buy hundreds of thousands of highly specialized chips like NVIDIA H100s and Blackwells, which cost tens of thousands of dollars each. Plus, you have to build custom, ultra-dense data centers.
And the cooling, right?
Oh, the cooling is massive. You have to install liquid cooling infrastructure because these chips run so hot they would literally melt traditional server racks. And you have to secure literal gigawatts of power from local utility grids.
Okay, so the physical constraints of the AI boom are incredibly expensive. I get that. But even with all that physical gear, $1 billion loss is steep.
Well, the gear is expensive, but the way they pay for it is what's truly dragging down the bottom line. They took on an enormous amount of debt to buy those chips and build those centers. And, debt isn't free.
Right.
That massive borrowing generated a $1.23 billion interest expense for the year.
Wait, just to service the debt. The interest alone was $1.23 billion.
Just the interest.
Yeah.
And that completely wiped out any operational gains they made. If you look at their operating loss, it flipped from a healthy $324 million profit in 2024 to a $46 million loss in 2025.
Man. And the fourth quarter of 2025 really proves this isn't just a one-off issue, right?
No, not at all.
Because they brought in $1.57 billion in revenue for just that quarter, but they still posted a net loss of $452 million. They missed the earnings per share consensus completely.
Yeah, it was a big miss.
Wall Street analysts expected them to lose 49 cents a share, but they actually lost 89 cents.
Yeah, and to sustain that kind of billion-dollar infrastructure burn rate, you can't just rely on incoming revenue. They had to go out and borrow heavily, which drastically changes their risk profile.
Brings us right to the balance sheet.
Exactly. They're currently sitting on $49.30 billion in total assets.
Which, I mean, that sounds impressive on paper, almost $50 billion in assets.
It is impressive. But against those assets, they're carrying roughly $30 billion in total debt. Now, to be fair, their core business is generating cash. Their cash flow from operations was $3.06 billion in fiscal year 2025.
Okay, I'm going to stop you right there because the math is not adding up for me. They have $3 billion in operating cash flow, but earlier you mentioned they're building out more data centers. What is the projected capital expenditure for next year?
Their capital expenditures, or CapEx, for 2026 is projected to be between $30 and $35 billion.
$30 to $35 billion.
Yeah.
That is roughly equivalent to their entire current debt load, and it's like 6 times their annual revenue. How does a company with $3 billion in cash flow survive a $35 billion bill? I mean, it sounds like they're building an absolute empire, but they're a rocket ship burning fuel so aggressively that they're in danger of melting their own engines.
That is the perfect way to visualize it, honestly. The sheer necessity of that burn rate is what makes the AI sector so ruthless right now. In the specialized AI infrastructure game, you either spend tens of billions to stay at the bleeding edge, or you instantly become obsolete.
There's no middle ground.
No middle ground at all. If CoreWeave decides to be financially conservative and, say, skip that $35 billion CapEx cycle, a competitor will gladly take on the debt, buy the next generation of chips, and just steal their market share overnight. CoreWeave loses its edge the exact moment it stops spending.
So that financial reality, this constant need for billions in fresh capital, has to be driving the wild price action we're seeing. I mean, the stock's 52-week range is incredibly wide. It's traded as low as $33.52 and as high as $187.
Yeah, that is the definition of a high beta stock. Beta is just a measure of volatility. If the broader stock market is a merry-go-round, a high beta stock like CoreWeave is a roller coaster.
Right.
It swings wildly in both directions based on market sentiment, AI hype, and of course interest rate fears.
So let's talk about how the market is violently reacting to that reality right now. We are sitting at $110.27 today. The stock is in the middle of a high volatility recovery phase following a really sharp correction. And the daily trading volume is just exploding.
The volume data is a massive clue here. We are seeing 55.75 million shares trading hands in recent sessions.
Wow.
Yeah, and compare that to a historical average volume of around 36 million.
That is almost a 20 million share jump. What does that kind of volume churn actually mean on the trading floor? Like, who is buying and selling?
Well, when you see volume spike that dramatically on a recovery swing, you are witnessing massive institutional churn. It means the big players, hedge funds, mutual funds, institutional algorithms, they're actively fighting over the price discovery of this asset.
So tug of war.
Exactly. Some institutions are buying the dip, believing the AI hype, while others are aggressively offloading their positions because they're terrified of the debt.
And technically speaking, for the traders out there looking at the charts, the short-term trend is flashing a neutral to bullish signal, right?
Yes, it is. The stock has broken out above two very critical moving averages. A moving average just smooths out the daily price fluctuations to show the underlying trend.
Right.
And CoreWeave has pushed above its 20-day moving average, which is in the mid-80s at $84.37, and has also cleared the 50-day average at $85.90. For momentum traders, clearing those mid-80s hurdles signals short-term strength.
And they are seeing immediate support around $102.11, which was the recent session low. But there is a ceiling they have to punch through. They have resistance at $114.10. And then there's a massive hurdle at the 61.8% Fibonacci retracement level, which sits at $128.37.
Let's pause for a second because Fibonacci retracement sounds like something out of a high school geometry textbook.
It does, yeah. But in trading, it's really just a psychological zone. These retracement levels are mathematical percentages that traders use to identify where a stock might bounce or stall after a big move.
The 61.8% level is the golden ratio. It is a critical line in the sand because thousands of algorithmic trading programs are hard-coded to execute automatic sell orders the exact moment the stock hits that price of $128.37.
So even if the stock rallies, it's constantly fighting gravity. The massive gap losses and that $30 billion debt burden, they act as an anchor, capping the long-term trend strength.
Right. Every single time the stock tries to run, the reality of the balance sheet pulls it back down.
But here is where it gets really interesting, and I need you to play devil's advocate for a second. If the short-term chart is breaking out and the company is posting 168% revenue growth, why on earth are the CEO and key insiders jumping ship and dumping hundreds of thousands of shares in the 70s and 80s just days ago?
Yeah, that is a massive red flag for retail investors.
It's crazy.
Just days ago, at the beginning of April, the CEO, Michael Intrator, dumped roughly 200,000 shares in the high 70s. And the very next day, another key insider, Brian Vituro, sold nearly 500,000 shares, around 490,000 shares, in the low 80s.
They dumped hundreds of thousands of shares right before the stock rallied to 110. Why? I mean, you say they might just be mitigating personal risk, but if I'm a retail investor, I'm looking at the CEO dumping stock and thinking the ship is sinking. Is it really just diversification?
It is a phenomenal question. High institutional order flow, mixed with heavy insider selling, often points to what we call a distribution phase. Institutional churn basically masks these insider exits.
I see.
The big funds are buying, which creates enough volume for the insiders to sell huge blocks of shares without instantly crashing the stock price.
But why sell now?
Because the insiders are looking at the exact same $30 billion debt cliff that we are. Look, as an executive, your entire net worth is overwhelmingly tied up in your company's equity. When your company takes on $30 billion in leverage to buy computer chips, your personal financial risk becomes astronomical.
That makes sense.
If the AI market cools even slightly, the company could default, the stock goes to zero, and your life savings is wiped out. So they lock in gains. They sell enough shares to ensure they are personally wealthy, regardless of whether the company ultimately survives its debt load.
That makes perfect sense from a personal finance perspective, but it is a terrifying signal for the market. And this glaring contradiction, a booming stock price versus fleeing insiders, it leads directly into this extreme divide among Wall Street analysts regarding CoreWeave's true value.
Oh, absolutely. The valuation debate surrounding CoreWeave right now is one of the widest, most polarized divides we have seen in recent market history.
So let's lay out the general consensus first. Mostly, the signals are pointing to buy or outperform. The one-year target estimate sits at $123.50. So there's a cautious optimism in the short term, but there are persistent negative signals flashing purely because of the cash burn.
Right, that is the middle ground. But the extremes are where it gets really interesting. Let's look at the undervalued case first. Growth-based financial models, like the ones utilized by Simply Walsaint, look at that unprecedented 168% revenue growth and project it years into the future.
Okay.
Based on those models, they estimate the fair value of the stock is actually 84.5% higher than current prices.
They think it's massively undervalued. But then you have the exact opposite camp. You have the value trap case. Traditional discounted cash flow models, or DCF models, signal extreme danger. They value the stock at just $30.88.
Yeah, a discrepancy from $30 to over $200. It is staggering.
Let me stop you there, because financial modeling can sound like a completely different language to a lot of people. So what does this all mean for you, the listener? How can one model say it is severely undervalued, and another says it is basically worth $30? It's like pricing a massive mansion based purely on its beautiful blueprints while completely ignoring the termite infestation eating the foundation.
That is exactly how you should think about it. And it really highlights why you must understand the mechanics behind these price targets. Growth models are entirely focused on CoreWeave's vision. They are mathematically assuming that CoreWeave will flawlessly navigate its $30 billion debt, successfully build out its power grid access, and completely dominate the AI market for the next decade.
Right. They are pricing in the mansion once it's completely finished and perfectly landscaped.
Correct. But a discounted cash flow model does not care about your beautiful blueprints. A DCS model is ruthless. It calculates the present value of a company based solely on the actual cash it is expected to generate in the near future.
So it looks at the burn rate?
Exactly. It looks at the massive daily cash burn, the $1.23 billion in interest payments, and the severe lack of free cash flow, and it heavily penalizes the valuation. It's the financial equivalent of saying, look, I don't care how great the blueprints look, you literally cannot afford to buy this deal.
So that valuation gap perfectly outlines the core debate. Let's break down the actual business fundamentals driving those two sides, the bull case versus the bear case, and the severe risks that retail traders are walking into.
Let's start with the bull case, which is the recovery and dominance scenario. The absolute strongest argument for CoreWeave is their backlog. They currently have $66.8 billion in contracted revenue.
Almost 67 billion in the pipeline. And just to be clear, contracted means what exactly?
It means these are not loose handshakes or, optimistic projections. These are ironclad, locked-in financial agreements. CoreWeave has the largest specialized AI cloud footprint globally, and it's secured by massive multi-year partnerships with heavyweights like Anthropic and Meta.
Right. If you are the foundational infrastructure powering Meta and Anthropic's AI development, you are quite literally the backbone of the entire AI revolution.
That is the fundamental bull thesis right there. They have the top-tier clients, they have the legally binding contracts. They just need the time and capital to build the infrastructure to service them. If they survive the build-out phase, they win the decade.
But the bear case, the continuation lower, revolves entirely around whether they can actually survive that build-out phase. It all comes down to refinancing risk. Out of that roughly $30 billion in total debt we discussed, $3.6 billion is maturing in the next 12 months.
Yeah, that is the ticking clock. They have to pay back or somehow refinance $3.6 billion this year.
Yeah.
And remember that mind-bending 2026 capital expenditure plan, the $30 to $35 billion they need to spend just to stay competitive.
Yeah, the rocket fuel.
Right. That kind of spending is going to absolutely crush their profit margins. It pushes any hope of real sustainable profitability to late 2027 at the absolute earliest.
Well, with a recent $3.5 billion convertible note offering teased in the sources, does that act as a lifeline to pay off that $3.6 billion due this year, or is it just digging the debt hole deeper?
It's a lifeline, sure, but it's a lifeline made of lead. Think of a convertible note as a massive corporate payday loan where the collateral is the company's future ownership. It raises cash today, which helps them meet that immediate near-term maturity. But it adds to their overall debt burden. And the convertible part is the real danger for retail investors.
Explain that conversion mechanism. How does that hurt the retail investor?
If the stock price goes up, the institutional investors who gave them that $3.5 billion loan have the right to convert their debt into newly minted shares of stock. When a company suddenly creates millions of new shares, it dilutes the value of all existing shares. Your slice of the pie gets smaller.
Got it.
So the retail investor takes on all the risk of the debt, but if the company succeeds, their reward is diluted by the institutions converting their notes.
Which brings us to the ultimate danger here, the retail trap. Retail traders log into their brokerage, they see the headlines about Anthropic and Meta partnerships, they see a $66 billion backlog, and they just hit the buy button. They buy into the hype of the AI revolution without realizing the company is staring down a short-term debt cliff that could force massive share dilution.
It is the classic trap. You buy the narrative without verifying the mechanics of the balance sheet.
So let's synthesize this into a timeline for our listeners. What should they be watching for as we move forward?
Well, in the short term, expect violent, erratic trading. The market is going to be incredibly reactive leading up to their next earnings date, which is May 20, 2026. Every piece of macro news, every rumor about NVIDIA chip delays, and every whisper about interest rates will cause massive price swings. It's going to be a trader's market, not an investor's market.
And looking long-term.
Long-term, the potential is truly undeniable. If CoreWeave somehow manages to survive this debt cycle, if they execute their $35 billion data center build-out without critical delays, they have a legitimate path to a $30 billion plus revenue run rate by the end of 2027.
Which would cement them as one of the most dominant and profitable technology companies on the planet.
Unquestionably.
Yeah.
But getting from here to there requires flawless execution with zero margin for error.
It really is the ultimate high-wire act. We are looking at a world-class AI infrastructure company that is growing faster than any cloud provider in history, yet they are saddled with a terrifying debt load and burning billions just to keep the lights on.
It is a financial thriller playing out in real time.
And before we give you our final thought to chew on, just a quick reminder, whether you are listening on your commute or watching us online, please take a second to like the video, subscribe to the channel, and drop a comment below. Your feedback tells us exactly what topics you want us to unpack next. Are you a bull buying the backlog or a bear terrified of the debt? Let us know.
And as you think about your position, consider this one final variable. CoreWeave's survival relies entirely on constant, aggressive expansion to service its mountain of debt. Their models assume that the demand for AI computation will only ever increase. What happens to that fragile, highly leveraged house of cards if the broader AI market cools down, even just a fraction, before they can refinance?